If you've been watching the financial news at all, you've seen the headlines. Inflation is up, the market is down. The Fed is hiking rates, and your portfolio is feeling the pain. It can seem like a chaotic, random mess. But what if I told you the relationship between inflation and the stock market is random at all? That it follows a very specific, almost predictable chain reaction. Understanding this chain reaction is the difference between being a passive victim of the economic cycle and an active, prepared investor who can not only protect their wealth, but actually find opportunity when others see only fear. Welcome! Today we are pulling back the curtain on one of the most critical forces in finance. We're going to break down, step by step, exactly how inflation affects the stock market, why certain sectors get demolished while others quietly thrive, and most importantly, what you can do about it right now. Let's get started. First, we have to get our definition straight. What exactly is inflation? The Consumer Price Index, or CPI, starts ticking higher. Now, on the surface, this might not sound all that bad for stocks. After all, companies sell things, right? If they can charge higher prices, shouldn't their revenues go up? In some cases, yes, but this is only one side of the equation. The problem is costs. Inflation doesn't just mean companies can charge more, it means their own costs are going up too. They have to pay more for raw materials, more for energy to run their factories, and more in wages to their employees. This is the first squeeze on corporate profitability. The margin between what a company sells a product for and what it costs to make it can start to get compressed. But this direct cost squeeze is often just the beginning. The real, earth-shattering impact comes from the reaction of the second character, the Federal Reserve. The Fed has a dual mandate: to promote maximum employment and to maintain stable prices. When inflation runs persistently above their target, typically around 2%, their job is to put out the fire. And they have only one major tool to do this: interest rates. So, Act 2, the Fed responds. Consumers might delay buying a new house or a new car because mortgage and auto loan rates are now too high. Businesses postpone expansions, halt new factory construction, and cut back on hiring because financing these projects is no longer as attractive. This slowdown in economic activity leads to a reduction in overall demand. So now, companies are facing a double whammy. First, their costs are still elevated from inflation, squeezing their margins from one side. People need to buy these items regardless of the economic cycle. While their costs may rise, they often have strong pricing power, meaning they can pass those higher costs on to consumers who have no choice but to pay. Finally, financials, particularly large banks, can sometimes benefit from a rising interest rate environment. They can earn a wider net interest margin, the difference between the interest they pay on deposits and the interest they charge on loans. So, what is a practical takeaway for you, the investor, navigating this environment? The first step is awareness. Pay attention to the key economic indicators, the monthly CPI and inflation reports, and most importantly, the Federal Reserve meetings and their dot plot of future rate projections. These events will set the tone for the market. Second, understand your own portfolio's composition. If you are heavily weighted in speculative growth stocks, you are inherently more exposed to an inflationary, rising rate regime. This doesn't mean you should sell everything in a panic. It means you might consider rebalancing to add more defensive exposure. This could mean shifting some capital into the sectors we just discussed: energy, staples, and certain value stocks with strong current cash flows and dividends. Another powerful tool is simply to look for companies with what economists call pricing power. These are businesses with such strong brands, unique technology, or dominant market positions that they can raise their prices without seeing a significant drop in sales. Think of iconic software companies with subscription models, or luxury goods makers. Their ability to maintain margins in the face of rising costs is a huge advantage. And finally, a word on cash. In a high inflation environment, cash is losing purchasing power sitting in your bank account. However, with the Fed raising rates, products like high-yield savings accounts, money market funds, and short-term treasury bills are now offering meaningful yields. This safe yield can be an attractive alternative to a volatile stock market, providing a place to park money while you wait for clearer opportunities.